Welcome back, traders. Thanks for joining me here today. In this short video, you will get to know which is better between the short-term and long-term patterns in technical analysis. You have learned what short and long-term patterns are all about. Some traders specialize in one form of analysis, but I believe the best way to implement the patterns trading technique is to blend both the short and long-term patterns together. The short and long-term patterns complement each other. Therefore, they mostly rely on each other for the best technical setups in the market. Remember, the long-term pattern is suitable for projecting the future direction of price movements in the market, while short-term patterns are suitable for projecting the best entrance level in the market. Although long-term pattern offers the most decent risk-to-reward ratio in the market. For these reasons, I would suggest you pair the long and short-term patterns in order to increase your winning probabilities in the market. In order to know which is the best between the long and short-term patterns, we need to learn more about the usefulness of the long-term patterns. Long-term patterns can be used in two ways, which are: number 1, for the continuation of a trend. Number 2, for the reversal of a bullish or bearish trend. The term continuation means after price made a counter-trend move against the dominion bullish or bearish trend. Price later continues or resumes the transformation of the dominion trend move. While reversal means after price made a counter-trend against the dominion bullish or bearish trend, price failed to resume the transformation of the dominion trend. And this resulted in a more counter-trend move, which later superseded the previous dominion trend. For a continuation setup, a bullish pattern should appear during an uptrend, and a bearish pattern should appear during a downtrend. Whenever a bearish pattern is seen in a bullish trend, it usually suggests the possibility of a change of the bullish trend into a bearish market. Likewise, the formation of a bullish pattern in a bearish trend suggests an imminent change of the bearish trend into a bullish trend. Let's get into more details on how long-term patterns can act for the continuation of trends in the market. To determine the formation of a continuation pattern, we need to learn how to identify a trend. A bullish trend, as we can see on this chart, is made up of swing higher highs and higher lows. This repetition of patterns is the characteristic of a bullish trend. Let's see the waves in a bearish trend. As we can see on this chart, a bearish trend is made up of swing lower highs and lower lows, while the balance between the bulls and bears is referred to as a ranging trend. Once a trend has been established on the higher time frame, statistically, it's likely to find a continuation pattern on the lower time frame. The formation of a continuation pattern on the lower time frame is what usually leads to price breakout on the higher time. As a beginner trader, stick to the trading of continuation patterns before proceeding to trade the reversal of a trend. Trading the reversal of a trend is more complex than when trading continuation patterns. Experienced traders sometimes find it difficult to identify possible reversal points in the market. I will show you how to identify continuation patterns before we proceed to how to confirm a possible reversal pattern in the market. Let's study this strong bullish chart here. What can you notice? We can see the continuous upward flow of this trend. Price repeatedly carve higher highs and higher lows. Now study the first pattern here. This pattern formation was an ascending triangular continuation pattern on the daily time frame. This pattern supports a bullish continuation of this strong bullish trend. Now let's see the 4-hour chart frame. Here's the 4-hour chart frame. We can see the formation of an inverse head and shoulders here. The inverse head and shoulders support the ascending triangular formation on the daily time frame. Traders who made an entry based on the 4-hour bullish breakout candlestick here would have to place their stop loss at the low of this inverse head and shoulder here. From the high of this bullish candlestick entry to the low of the inverse head and shoulder here is 140 pips. From the high of this bullish candlestick entry to the high of the reversal here is 145 pips. Through proper money management analysis, a trader in a long position should have moved his or her stop loss to the entry break-even level to prevent loss. Remember, no trading system is infallible to the market. Now let's check on the daily chart once again. The second formation we have in this bullish trend was a double bottom continuation pattern. This pattern supports a bullish continuation of this strong bullish trend. Now let's see the 4-hour chart frame. Here's the 4-hour chart frame. We can see the formation of higher highs and higher lows to the dynamic resistance trendline here. The formation of this wave was in line with the double bottom long-term continuation pattern on the daily time frame. We can see the massive bullish breakout. Price went too far, therefore we need to wait for a bearish pullback to reduce our risk level in this bullish continuation setup. We can see price later retested the point of breakout. The level here acted as a new support level for price, and the double bottom bullish continuation long-term pattern was confirmed. Let's check on the third bullish continuation pattern on the daily time frame. The third long-term pattern here is a bullish flag. We can see this pattern was in conformity with the strong bullish trend. We can see how price broke out of the pattern. Let's check the 4-hour time frame. Here's the 4-hour time frame. We can see price carved higher lows to the dynamic resistant trendline of the bullish flag. Price made a bearish retest of the broken dynamic resistance trendline, and it turned into a new support level for price. We can see how the bullish flag pattern led the bullish trend into a more bullish rally. This is how you can verify a long-term continuation pattern for a bullish trend. To verify a long-term continuation pattern for a bearish trend, you have to watch out for a bearish pattern supporting the existing bearish trend. In the next video, I will explain how this long-term pattern here acted for the reversal of this bullish trend into a bearish trend.